Good morning and welcome to the Coinbase Institutional Markets Call. It is Tuesday, March 12th, and we now officially have a new Bitcoin all-time high. We traded 72,943 on Coinbase Prime, the only place where you should be doing your trading. Obviously, I'm slightly biased, but it is genuinely true, which puts any question out of the way whether or not we've hit an all-time high. So super happy to see that, and congrats to all those that hold some Bitcoin. Have a fantastic call today. We're going to be covering crypto and AI. We've had some really big moves in WorldCoin, Fetch AI, and various others. We're going to cover meme coins. How can we avoid the slightly crazy but also very fun and amusing part of the space? We're covering the BTC Halvening, ordinals, and also obviously BTC ETFs, which there's been a ton going on there as well. We're then going to run through some of the more technical side of things with the Dencun fork, which is happening tomorrow. And also talk through the ETF probabilities as well, which have been updated by our friends over at Bloomberg, who, to be fair, have been very good of late. We're also going to run through some on-chain activity that's possible post the Dencun upgrade, a frames update, and David's going to run us through the CPI print this morning and what that means for the market. But without further ado, if you're listening on YouTube, don't forget to scan the QR code to access all of David's fantastic research. If you are listening on podcast, that will be in the show notes. And of course, no matter what platform you are listening or viewing us on, don't forget to like and subscribe. And we really appreciate any of those positive 5-star reviews. So thank you very much. So now we've got all of that out of the way, George, can you bring us up to speed? What's been happening in the market this week?
Yeah, it's definitely been super interesting, Ben. Price action, I'd say, has been nothing short of impressive, with price discovery mode in BTC on after hitting 72K. And equally, a really impressive bull run in a couple of altcoin segments like AI coins, something that I was looking at, or meme coins, for instance, as well. So Floki, as one example, is up 105% over the week. Fetch AI up 51%. WorldCoin up 34% as well. And the other interesting thing is...
Just one quick one. Just on Floki,
sure.
There's a gazillion meme coins out there. Like, why Floki? Why is that the one that's kind of captures people's attention?
I mean, this is just one example. I think that there's been a lot of others, let's say, that have been popping up and maybe are lower cap, but have outperformed it by many times. But, I think sort of looking at the big picture of it, you have this internet culture or meme culture, right? And the way I look at it is kind of something that events or ideas that form sort of this contemporary zeitgeist, right, and take some inspiration from there. So you could look at political events that come, for instance, and if there's opportunities with memes related to that, or technological breakthroughs, right? So I mean, there was some talk about WorldCoin sort of being this AI, or the largest AI meme in a way in the space, right? Or it could be as simple as buying dog-related coins, or I think actually the last 24 hours, a lot of cat-related coins were taking off. So in a way, it's kind of like, it reminds me a little bit, let's say, of the last bull run, right? When you had like Doge moving, then SHIB, then you had Floki, and definitely remember all the ads on London buses and the underground with Floki. I mean,
that makes a ton of sense. I think like it's so hard, and I guess looking across the ecosystem of meme coins, you can almost tier them now. You've got the larger cap ones. You mentioned a few of them, the ones that people know, and then you've got smaller cap ones. And I guess what struck out for me was like it was a larger cap one moving so much in a particular week. But moving on, just onto Fetch, obviously that's AI related. These have seen a ton of uptake. That confluence of crypto and AI seems to be carrying on people pretty strong. Is there anything specific to that, or is it really just kind of along the same train of thinking?
Well, yeah, I think it's just sort of you have this narrative rotation happening, right? And I think typically what's discussed, right, like in terms of the leading narratives for this cycle, AI is in that top 3 probably, or that intersection between crypto and AI rather. And you could see that with this NVIDIA AI conference happening, right? Like, so Fetch, for instance, I think it's done a 2x over the last 10 days or so, pretty much. And you had a bit of a dip in some of these AI coins about 2.5 weeks ago, right? And then as soon as folks started talking about that NVIDIA AI conference, right, suddenly everyone started jumping on it again. And just a fun fact, by the way, I've seen someone post comparing the market caps on Twitter. So NVIDIA market cap is obviously 2.1 trillion, and the whole sort of crypto AI complex, I was checking on CoinGecko this morning, is about $27 billion total market cap. So it does look like there will be opportunities around.
So I feel like that's an unfair comparison. As much as I would love to anchor people to NVIDIA as a comp for AI meme coins, I'm not sure that's the fairest comparison. But I could be wrong. Maybe I'm too bearish. I think one thing on the NVIDIA thing, actually, I saw that Anir were actually on a panel with the NVIDIA CEO, which I have to say I haven't gone into depth there, but that kind of blew my mind slightly. And full disclosure, it's probably a project that I could do a little more learning on, but I was surprised to see them. Render obviously are kind of closer to NVIDIA, and I think that's been well known for a while, but Anir was certainly a surprise there. And then WorldCoin. So this one continues to trade higher. Speaking to a lot of investors, the float there is still very, very small. But what's happened this week? Is it again just like AI related, and that's why?
Yeah, exactly. I think so. It's just a rotation, isn't it? And I agree. I mean, you have unlocks, I think, now coming up steadily until July. I think, if I'm not mistaken, in July there's going to be a bigger unlock. And as you say, I mean, the FTV is obviously is super high, almost approaching $100 billion. So, but it is obviously, given it's a new SAM coin, right? That makes it very zeitgeisty, if that's a word that you can use, right?
Well, yeah, we'll go with it. I like it. It sounds like a fun word. ETH price, we've broken 4K. Bitcoin obviously new all-time highs officially this week. I feel like the last couple of weeks we've kind of said it but haven't really meant it. So that's been interesting. BTC dominance, I know you haven't got it on the chart, but it's still pretty high. Can you run us through kind of why that might be?
Yeah, for sure. So, I mean, if you look at where we stand now, BTC dominance is about 54%. So that's still the highest since April 21, right? If you look at total market cap right now, we're at 2.6 trillion. All-time high is 3 trillion. So we're actually pretty close, right? But the last time we were here, in terms of market cap, BTC dominance was at 40%. But obviously the big difference here is that last cycle institutional adoption to a large extent was a meme, right? Whereas this time around it is real. And I mean, all you need to do is just look at some of the ETF numbers, right? That we've been seeing. So I think in this way, I mean, this cycle could be somewhat different, but the other thing is I still think that, as this cycle is going to mature, I think BTC dominance eventually will also start to decrease, and I think that there will be a ton of opportunity, and that still is now in the altcoin segments as well.
Yeah, it makes a ton of sense. I mean, ETH has kind of performed super well, and like in any normal market, you'd see BTC significantly higher, but Bitcoin's just been running such a strong race; it's kind of struggled to catch up. Just going back to the ETFs, George, like what are the latest numbers on the ETF side of things?
Yeah, totally. I mean, 100% agree with you. Like normally, you would have like last couple of cycles, it would trickle down to ETH and then further out in the risk curve. But yeah, this time around, as you say, like folks just moved out on the risk curve very, very much sooner than, let's say, in typical cycles. But yeah, looking at the ETFs numbers, total inflows into the new products now are standing at just over $20 billion. So that's really impressive. And net inflows, obviously, if you adjust for GBTC outflows, are around $10 billion into the new products. And momentum is really strong. And I think there was a report circulating last summer that was, and I think 13D Research may have picked up some of these numbers a couple of weeks ago, saying that $50 billion in inflows over the first 3 years and 15 billion over the first year would be very bullish. And obviously now we're 2 months in, and it's already at 10 billion. So that is very, very impressive. And GBTC is now also, by the way, just a little bit less than 50% of the market share across all the spot ETF products. IBIT, the leader, clearly with just over 14 billion market cap as of end of day yesterday.
Amazing. So there's some fun numbers there in terms of market cap. Oh, just want to bring Greg in here to discuss these as well. Greg, I think there's a few more stats you've been looking at that are kind of fun from an ETF perspective.
Yeah, thanks, Ben. So it's been reported now that the U.S. spot Bitcoin ETFs hold just about 4% of all of the Bitcoin. So that's a decent amount, but not huge. I think it's just indicative of the fact that this new pool of capital is open, and I would expect that number to continue to climb from 4%, up, 10, 15, maybe even higher as these products get released on all these different financial advisor platforms. One thing to keep in mind, though, is Bitcoin can come out of these ETFs as fast as it went in. So, I think it's really good that that we're seeing adoption from the TradFi and retail sector. But it's not a situation where this Bitcoin's being locked away and will never come back on market. This is just now a new liquidity pool for our asset. And, we'll be subject to market whims just like we were previously.
So it's interesting you say that, Greg. 4% of BTN ETFs after 6 to 8 weeks. I think that's a lot. I feel like that's like a crazy amount. I know, I agree it will go higher, but I feel like in a short period of time, that's like serious amounts.
Oh yeah, it's certainly don't let me give you the wrong idea. It's certainly a big number, but I just expect, we're just it's still in the very early innings of these products. And this is a really efficient way for folks to get crypto exposure. So, I do expect that number to continue to grow, as we kind of move through time here.
Yeah, it's interesting. The Bloomberg analysts, James Seifert and Eric Bartunis, were commenting that the target of gold's market cap is actually too small now, and Bitcoin needs to be looking at the next target, which should be something larger, which they didn't really clearly explain. But interesting, its market cap is now larger than silver, so I guess that's one hurdle out of the way. So we've been discussing it, George. They would love to bring you guys in here around what happens if too much BTC goes into these ETFs. Maybe David, if you could kind of lead off here, and I know George, you've had conversations around this. And just to be clear here, guys, we're not looking to be bearish. We're just kind of offering an interesting opinion of what happens if 50% of the Bitcoin ends up in ETFs. So David, do you mind just kind of explaining what that concept was?
Yeah, I think there's this mistaken idea that if you own 51% of the Bitcoin supply out there, then somehow you have control of the network, which isn't the case. And I think this goes back to the idea of 51% attacks on the Bitcoin network itself, because the idea of owning Bitcoin grants you nothing in terms of control over the network. It doesn't give you control of the nodes. It doesn't give you control of the code. Really, the only way to actually engage in a 51% attack is to have 51% control of the network. So you need to actually be able to be a miner to do that. So I think that this is just a misunderstanding in terms of people thinking that concentration of Bitcoin ownership itself actually has some sort of network vulnerability.
Amazing. And George, what was there's an angle there around security as well, if I remember rightly.
Yeah. So, it's definitely, as you say, with this tremendous success of the ETFs, right, something that has been coming up in some client conversations is folks asking themselves the question, okay, what if these ETFs are too successful, right? And that's what David was just explaining, with too much of the liquid supply getting sucked up into these ETFs, right? And I guess, obviously, over the longer term, for the network to be sustainable, I guess miners need to be able to have a higher proportion of their revenue being generated by transactions on the chain, rather than just mining new coins at some stage, right? And here, eventually, the question becomes if too much BTC is sort of sitting there like dead capital in a way, sort of locked up and stashed away in all of these ETFs, right? I've heard actually someone even asking the question, would some of these big ETF providers have to set up their own miners to, kind of stabilize the network and keep mining to avoid any issues there. But I mean, I think at this stage, obviously, this is very unrealistic, as David said. I think it's more to say about the psychology of the market at the moment, that folks are worrying about these kind of things rather than, if we just think back like 6, 7, 8 months ago, there were totally different questions in everyone's head.
I think we're all uncomfortable in a bull market, aren't we? We're all just like, what can go wrong? Like, this doesn't feel normal. Like, why? What can we think about that we should be worried about? Which, only the paranoid survive, as Andy Groves says. It does feel like these things the flows aren't going to change, that's for sure. Not in the short term, at least, anyway. You've got the LSE accepting ETN applications as well, and flows continue to be good. One thing, just while we're on Bitcoin, David, would love. Obviously, we've got the Halvening coming up. Would love to kind of hear your thoughts on that, and also like ordinals. To George's point around actually the kind of the network being used for things and transaction fees being a kind of a revenue stream. So yeah, David, maybe we'd love to kind of a couple of highlights on that. If that's all right.
Yeah, I think the way the market is kind of setting this up right now is that they're talking about the enormous amount of ETF flows that are going into a reducing amount of new Bitcoin supply coming from the miners themselves. And while I think that, that prospect itself is very interesting, because I think, even if you did just some basic conservative math, for example, and say like right now in February, for example, we got $6 billion worth of net inflows in just a month. But let's say that the actual flows themselves start to slow down. That goes to around like $1 billion. Still, like if you were talking about 13,500 new Bitcoin being produced, which is half of what it's currently being produced by the miners, we're talking about an equilibrium price of $74,000. That seems very attractive, but I would say that that kind of sets up this false dichotomy that the only supply we need to be worried about is coming from the miners themselves. That's not true. The amount of liquid supply that we actually have has actually been increasing over the last 3 months. In fact, it's increased by around like 1.3 million Bitcoin over that period of time, compared to around like 150,000 new Bitcoin that has been mined. So there are other sources of Bitcoin supply, to kind of allude to what Greg was saying earlier, that we need to be kind of concerned about. Now, that said, we are still seeing that even though the amount of Bitcoin getting to exchanges has actually increased rapidly over the last few months, we are still seeing that a net 80,000 Bitcoin is coming off of those exchanges. So not just the ETFs themselves, but probably some other source of demand is leading to support this market and help to absorb that supply.
Yeah, that makes a ton of sense. So let's move on to ETH. That's obviously been in a lot of people's minds post the BT ETF. Like, are we going to see an ETH ETF? So Greg, what are we kind of hearing out in the market about probabilities in the ETH ETF?
Yeah, so ETH, as you mentioned, or the ETH ETF has been seen as the next trade after the Bitcoin spot ETF. The important deadline to keep in mind here is basically mid-May is when we expect to find out if this gets approved. Now, the Bloomberg analysts that have been following both the Bitcoin ETF and the ETH ETF applications very closely recently lowered their probability of an ETF getting approved to about 30%. Now, they're very clear to say 30% is not zero, but they do see a lower chance of this being approved. And the reason they're giving these lower odds is, in their view, there's a lack of communication from the SEC. They would have expected to see more back and forth between the SEC and the issuers. And because it's just been quieter than expected, they're now suggesting, a 1/3 chance that this gets approved. That being said, as we take a look at our screens, ETH continues to perform very well. Like you mentioned earlier in the call, broke through 4,000. And I think that's because, obviously a potential ETF is important, but we also have the Dencun upgrade this week. That's another very important narrative.
Yeah, that makes a ton of sense. I guess we'll see as time goes on. The discount for the ETH product is certainly trading at its narrowest point for some time as well, which indicates people are pretty bullish there. But I'd say the Bloomberg analysts have been pretty good. their predictions have been pretty solid, so I wouldn't necessarily want to bet against them, but who knows. Moving to Dencun. So David, we'd love to kind of hear your thoughts, just maybe a quick summary on Dencun, and then Sid, we'd love to bring you in and hear about what that means to all of the fun and games that you have on chain.
Yeah, so the Dencun fork is going to be activated on Ethereum mainnet on March 13th. We call it Dencun because they combine the names Deneb and Cancun. But really quick, I think the main thing you need to know is that this focuses on the L2s as the main beneficiary because proto-dank sharding in EIP 4844 is going to reduce those fees on those L2s by 2 to 10x. And it does that because it incorporates binary large objects, otherwise affectionately called blobs, into these blocks. And that's going to be dedicated only to the L2s themselves. So I think that mainly what you got to keep in mind, reducing the cost of block space for L2s. How does this impact ETH revenue? I think it's really going to be the big question, because I think there are some concerns that this could be dilutive to ETH revenue in the very short term. But we have argued previously that L2 activity today really only contributes around 10% of transaction fees on average. So I still think that the impact from Dencun on ETH itself will be relatively small. And in fact, there's another upgrade which no one's talking about, which is EIP 7514, which will also be enabled in this upgrade. And that will reduce the max validated churn limit to 8 per epoch. And it's currently around 14 per epoch. But the reason that's important is because it's going to slow down the pace at which the validator set itself grows. And so it's going to affect the absolute level of the staking rewards.
Okay, so we've got two things there. The 7514, let's just quickly finish on that one before we go back to 4844.
Yes.
So slowing down the validator set allows staking yields to remain higher, which means more people are going to continue to stake and therefore increase the security. Is that a fair run of events?
I think so. And we also have new kind of primitives coming out with the idea of like liquid restaking tokens as well. And I think that that's also contributing to the move that we've been seeing. It's also been supporting the DeFi kind of activity here. That's also been very good for ETH.
Got it. Okay, cool. Sid, right, what are you going to do on chain post 4844 that you can do? Like, what are some of the things that are going to be cheaper, easier, quicker, etc.?
To be honest, almost every transaction on an L2 becomes drastically cheaper post 4844. And a lot of the novel use cases, we had Jesse on the call last week, the kind of novel use cases that are being experimented on at the edges of the application layer. I think that's what I'm most excited about. We've covered in previous segments things related to the social side of things with decentralized social, tipping people, having on-chain games operate with in-game currencies and flowing more smoothly. With fees being cheaper, a lot more can be put on-chain. And so that increases the scope of what's possible. Just to context that a little bit, I mean, that like the predictions are kind of vary quite broadly in terms of how much fee reduction can actually happen. Like currently, for example, I ran a calculation where an average Uniswap swap on base costs around 58 cents, and then post upgrade it could cost as little as 1/10 of a cent, which is incredible. But in terms of activities on chain, we can look at Solana as an example. Solana fees are actually even lower than proposed post upgrade L2 fees. But the kinds of activities that are potentially possible on Solana, we should probably start to get closer to those on L2s as we move forward.
Interesting. And is there a plan to upgrade beyond 4844 to get fees even lower, so it's even less than Solana in the longer term?
So right now there's a few different streams of discussions happening. David can chime in here as well, but the key distinction here is ETH mainnet isn't really any better off necessarily in terms of actually transacting on mainnet after this upgrade, which is a big gripe with a lot of users. There's still a lot of activity on mainnet. There's still a lot of legacy tokens that live on mainnet or dApps that are built on mainnet and haven't migrated to L2s. And it costs several $100 to make any average DeFi transaction on mainnet, right? So one of the streams of discussion is to actually increase the gas limit, increase the size of blocks, etc. There's several streams of discussions going on there to make mainnet actually more tenable to transactions. And then moving forward, the upgrade introduces blobs, which is a kind of a data availability layer on Ethereum. But there's also other data availability layers available, so which are potentially could be cheaper. We'll see how the metrics play out over the coming weeks. So depending on how these L2s migrate over, what kind of decision making they choose, there's solutions like Celestia, Near, and other data availability solutions that could potentially be cheaper, making the it kind of a race to the bottom in terms of how cheap they can get.
Yeah, interesting. I will say, like, executing transactions on Base. I bought a Base hoodie the other day, inspired by using frames from Jesse and stuff. It was pretty seamless, like super quick. No Girl Scout cookies yet. I figured that's a little worse for my health, so I've avoided those. But the and then on Solana, executing on Solana is just the same. It's super quick, easy, cheap. And when you're doing stuff on L1, it definitely just slows things down, doesn't it? You have to think twice, and it's expensive. So yeah, excited to see all these things go live. Sid, while we've got you, maybe like a quick update on Frames and Farcaster. Any kind of new developments this week worth noting?
Yeah, so last Friday, the transactions via Frames went live, which is interesting because folks can now execute on-chain transactions. Currently, it's only restricted to Base and Optimism, but we've seen a bunch of Frames already take advantage of this. There's Frames that offer swaps. There's Frames that offer basic functionality like donating money to a cause, etc., to a separate user or to a different project, etc. But I think over the coming weeks, potentially we see more sophisticated, and especially with the fee reduction, we might see more sophisticated apps take advantage of this as a user onboarding mechanism, but also as a social native kind of application where you can have games embedded within the social feed, all with on-chain transactions possible at a fraction of the cost that they currently cost, right? So it should be interesting.
Very cool. We'll watch this space. Cool. Thank you, Sid. We'll be back with you later on a few of the bits and bobs. But David, we had some important macro data this morning with CPI. Do you want to just run us through that?
Yeah, so this is important because we have a Fed meeting coming up on March 19th, 20th. But we saw that the CPI basically came in slightly above expectations. It wasn't too much higher. So year on year, CPI came in at 3.2%. Core CPI came in at 3.8%. But that compares to median forecasts of 3.1% and 3.7% respectively. So it's not really strong, but it doesn't show that it's bottomed. More than anything, it just proves that inflation is kind of stubborn here, which we knew was going to happen because the last mile of getting inflation down is always the toughest part. But I think there's a lot of focus on the super core measure, and that would be the core services prices excluding shelter. And we are seeing that that's coming down because it was very high in January. It was around 0.8%, or I think 0.85%, excuse me, in January month on month. But this has come down to around 0.47%. But for Fed policymakers, what we really need to see is this still too high? Because they would want to see this number closer to around 0.2%, which was kind of the level we saw on average before the pandemic. So I think that's one to watch. Still, though, I think the idea of the dollar kind of picking up on the margin is more of my concern because that's going to directly impact us. We are seeing that 2-year rates are picking up, but I don't think that overall this is going to change the Fed stance. I mean, we were never going to expect them to cut rates in March, but I still think that May is very much in the picture.
Perfect. So it's sticky, but not sticky enough to change where you think the rate path is, and the first cut is potentially still May. Is that fair?
I do, yeah. But I think that this kind of shows us that for the most part, the macro headwinds themselves, even though I think many of us are pricing in a soft landing scenario, the macro headwinds haven't gone away. And I think that concerns around technical factors, like if there's not enough liquidity out there, for example, if we've already kind of deployed a lot over the course of the last 2 months, this could still impact us in crypto. But for the time being, I think that, things look okay with the CPI print.
Got it. Yeah, that makes sense. I'd say Bitcoin hasn't really moved, just flat on the day. ETH a little bit lower. I think there was a little bit of weakness on the number, but not a ton. Would love to transition here to rates in DeFi, which I think are kind of somewhat relevant and somewhat related in some ways. So Greg, would love to bring you in here, and David, stick around. Do you mind just running us through like what rates are looking like and why they're elevated?
Yeah, so an interesting anomaly, you might say, is the cost to borrow stable coins, and likewise the cost or what you earn when you lend a stable coin on some of these over collateralized platforms like Aave and Compound and similar platforms is north of 20% right now. And what that means is you could take dollars from your bank account, mint a stable coin, deposit it on one of these over collateralized platforms, and earn a very healthy yield. The question is, why do these yields exist? And the reason they exist, we believe, is because there's just a thirst for dollars and really leverage in the system. When you have perp funding rates at 50+%, what folks will look to do is deposit say Bitcoin onto wrapped Bitcoin or ETH onto one of these platforms, borrow USDC, and then lever up in that fashion. And because of that, we're seeing really high demand for stable coins, and really high rates get paid. So, what does this mean? It means if you're looking at perp funding rates and you're thinking about doing that ARB, but maybe it's a little more difficult because you're in the United States or you're not set up on some of these exchanges, another way to access a portion of that return would be through stable coins.
Yeah, that makes a ton of sense, and a lot easier on L2s. If you're going to be going through a ton of transactions, going to be eating into your returns there. So I guess that those higher funding rates and your ability to earn has definitely affected other platforms in the space, MakerDAO being one of them. David, would love you to kind of run us through an update there, and Sid bring you into just to kind of talk through some of the mechanics for that and other stable coins.
Yeah, so there was a pretty big headline recently that suggested MakerDAO it has doubled the stability fees for DAI. And they're also increasing the DAI savings rate from 5% to 15%. And they did that because they've seen a decline in DAI supply that's dipped from about like $5 billion ish to around 4.4. And that happened all in a very short period of time. So to their credit, they got a proposal submitted and then approved very quickly in order to kind of rectify that. And the concern is that because the collateral sitting in the vault is so heavily skewed now towards real world assets, that it's not liquid enough to actually redeem enough DAI in a very quick way. So they need to kind of help restrict some of that and stabilize the price by actually committing to those two proposals.
Yeah, that makes a ton of sense. And Sid, when you look at this on chain, obviously everything is available for everyone to see. Is there anything else that we're missing that we should be cognizant of, or any kind of big moves that people are making?
Yeah, I think it's just a case of comparing rates across venues. So the kind of fundamental issue with this whole DAI situation, why they necessitated the change, was they were kind of mispricing the cost to borrow from their native lending protocol that's called Spark protocol, because DeFi rates have risen so much. On several venues, it's 30% where you can supply DAI and earn a yield of 30%. The cost to borrow DAI from MakerDAO was much cheaper. And so there was a pretty big arbitrage, funding rate arbitrage to be had. And this is not saying anything of the centralized exchange funding rates, which are, of course, on another level entirely, which is being represented by projects like Athena, in a DeFi native format. So funding rates across the board are pretty high. So there's a lot of arbitrage opportunities between venues. And so that's why these adjustments are taking place. And even in smaller lending markets, we're kind of seeing this where sometimes they have limits or incentives in place where they have to kind of adjust so that things are kept stable.
Yeah, that's it. Good to have stable coins generally. Cool. And then just on the DAO side of things, there was a headline recently that the legal standing for DAOs is now official in Wyoming. So small state, but important from a crypto perspective. So I imagine we'll see more DAOs moving there as well. Now, I think as we think about funding rates, like one would assume that people are trading, flows are going to be it's going to be pretty active. So Greg, we'd love to kind of hear from you. What's going on in the desk and what are flows looking like? What are clients saying?
Yeah, as you'd expect, volumes are really up across the board, really regardless of what part of the market you're looking at, the majors, altcoins, or stables for that matter. One thing we have been talking about on the desk, though, is we're at all-time highs in Bitcoin. Other tokens are trading very, very well. But there doesn't seem to be that euphoria that there was at the peak of last cycles. And, what I mean by that is, people are still, rather happy to passively work orders, work into positions over time. No one's falling over themselves to quickly get risk on or off for that matter. And it's all trading in a very orderly fashion. And I think that's a really good sign for the market because there's not that exuberance that you generally see at, local highs.
Interesting. So what do you think comes next?
I wouldn't be surprised if we see a little bit of a pullback here. It's just been, really one way for a really long time. That being said, trying to time these things is nearly impossible. I haven't spoken to really anybody who's not constructive in the medium and long term. And we've talked about all the reasons, why one would have that view. Obviously the flows in the ETF help, potential rate cuts later this year, an economy that seems to be humming along, new use cases in crypto, whether that be, consumer apps, gaming, cheaper fees in the pipeline. So, a lot of reasons to be sort of medium, long-term bullish. Again, we keep talking about these very high funding rates. That is a risk in the medium or in the short term rather, because if things stop going up, it gets very expensive to hold on to those positions. And then we could see some length come out. But I'll end on the pain trade has been up. So I wouldn't surprise me to see, any real dips get bought.
Yeah, 100% agree. I feel like a ton of people are waiting for any dips, part A and then part B. As you said, the setup is very constructive. Interestingly, the number of people speaking about 100K Bitcoin has gone up significantly. And kind of how soon that comes is certainly a lot sooner than it has been previously. Anyway, we shall leave everyone on that note. Appreciate everyone dialing in and listening. Have a lovely week. Take care.